as we speak, right now, there are 6 dividend stocks trading at some pretty serious discounts that I at least bare minimum want on your radar. So following our macro update, that's exactly what you're in store for here. With that, are you ready? Now, this past week, I'm going to be honest, we really didn't get any new news that was particularly game-changing. And a matter of fact, data set-wise, across economic reports, we didn't get much of really anything. So what was the who, what, and why behind our market giddy-up this past week? Well, none other than Jerome Powell himself while speaking at a central banking forum in Europe, to which he shared, drumroll please, the Federal Reserve has seen some progress on inflation, but proceeded to then share that the Federal Reserve wanted more confidence that inflation is in fact moving sustainably towards the 2% goal before we, as in the Federal Reserve, start the process of reducing policy or loosening policy. Now, following Powell's remarks, Treasury yields actually eased a bit and all major indices rose from their session lows, which in my opinion just reiterates the fact that the market is super sensitive to Fed speak and honestly eagerly just awaiting interest rate cuts, which then again in my opinion here would really fire up the market on all cylinders to hit some higher highs that we haven't seen before. But until then, I think we're just going to get a lot of this ebbing and flowing from week to week, and the question for all investors really just becomes which businesses will thrive and which will die, or at least be better off in this environment. However, as a long-term dividend investor, this is where I get really busy just doubling down on incredibly high-quality companies while they remain on sale. Now, the 6 dividend stocks that I actually am going to mention for you today have common traits, from being leaders in their respective industries, having strong brand names, having steady leadership teams, and really clean balance sheets, making them all ripe for investors who are seeking reliability when it comes to passive income for the long term. But I want to go ahead and warn you now. Each of these companies are in fact impacted in some way, shape, or form by our economic environment, to which we all again need to be in them for the long term. So have that in mind, but without further ado, let's kick off with a stock that captured literally everyone's attention this past week, Nike, ticker symbol NKE, which is of course Phil Knight's shoe empire dominating the athletic wear industry from head to toe apparel. Now right off the bat here, we're talking about luxury items when it comes to Nike during a time in which all consumers are in fact pressed to save. So consumer trends play a role here in sales and Nike's bottom line. And I can tell you that the company has in fact seen better days as reflected in their current share price of $75 per share, the PE ratio coming in at 20.4. Now investors, at this price, you could buy their stock for less than their shoes. But zoom out with me to see over 116% worth of appreciation over the last decade. And as of this video, analysts remain bullish on Nike, forecasting over 25% worth of upside, with the share price shooting up to $94.50 per share, all while hedge funds have been busy buying, scoring over 6.4 million shares last quarter as the stock was battered down in the red. So if smart money is all gun-ho about this opportunity and just did it, why aren't you? Now, as for dividend investors who want that passive income, we got a 1.97% dividend yield coming in. Yes, it's a bit lower, but remains safe according to Simply Safe Dividends, and it's going to continue to deliver through on growth, on average 15% worth of it year over year so far, while continuing on its 40-year track record. But if Nike doesn't make you want to just do it and add it to your list, there's a restaurant play that is looking really good as it falls deeper into the red. We got Darden Restaurants, ticker symbol DRI, which operates some of the most popular branded restaurants within the United States, from the Olive Garden to Longhorn Steakhouse, Eddie V's Seafood, and their more fancier Capitol Grill. Of course, Darden is also battling the woes of consumer trend shifts as Nike is, so we have Darden deep here in the red, trading for $145 per share, which is over 10% down on the year, with a PE at 17.2. But over the last decade, we see over 375% worth of appreciation, which tells me that through the good times and the bad times, people still got to eat out, or at least want to eat out and enjoy themselves. Now, while it's not the smartest thing to do, they do it. As for analysts, they're there to say that there's 20% worth of upside expected, with a share price at $175.13 coming in hot. And until then, it's going to be a savory dividend yield for you to collect on at a 3.85% yield. That's been growing like crazy for the restaurant operator here, with an average growth rate of 23% year over year for the last 20 years. Now, Nike and Darden are actually some of the riskier bets that I'm going to mention today. So the next 4 dividend stocks are only going to muster up some more reliability for your portfolio portfolio and I think really shore up some confidence for you as an investor. But before I cover them, investors, if you're taking value away from this video and you fall within the camp of the roughly 70% of viewers out there that are not subscribed, just want to ask for your help directly right now and ask you to join me on this journey. Hit subscribe to get that percentage down to 50%. That's my goal, and it would mean a great deal to me as I seek to put more focus onto this channel for all of you, meaning more dividend stock ideas on a weekly basis, macro insights, and even better masters of the market guests. But I really do need this community to grow, which really does require your help. Moreover, if videos like these are actually what you want more of, I want you to go ahead and just tap on that thumbs up button for me to let me know that this is exactly what you're looking for. From there, I'll double down on videos like this to deliver through on more dividend stock ideas. Okay, with all of that said, let's get back to it with Pepsi, ticker symbol PEP, which I know you know is a beverage behemoth, right up there with Coca-Cola. But many of you probably don't know that Pepsi is not only just a beverage company, but actually in the business of salty snacks, meaning a whole heck of a lot more revenue streams and profitability through product diversification. Now, Pepsi faltered earlier on in the year from some product concerns in the weight loss vertical, only to stage a pretty nice comeback and then lose some ground once again, to which right now we're seeing Pepsi trading at an attractive $162 per share. That's down from $181 back in May, and if we zoom out to the 10-year window here, we can see a money-printing green machine with over 141% worth of appreciation over that time. So give Pepsi time, as analysts forecast another solid player here coming in the game, climbing up to $183 per share and 33 cents. That's 12+% worth of upside from here, while hedge funds have only doubled down on this opportunity, scoring more than 150,000 shares last quarter, while the stock hovered at current values, meaning there is in fact still time for you until the comeback. You're going to enjoy the cool 3.33% dividend yield that has been reliably paid out for the last 59 years, while continuing to grow by an average of 11% year over year. Next up, I want to go ahead and jump into the healthcare sector with you with Johnson & Johnson, ticker symbol J&J, as this medical device and pharmaceutical juggernaut trades around its 52-week low mark here at $145 per share and hovering with a PE at 21. Now, the majority of healthcare companies out there have actually taken a pretty massive hit this year, especially when it comes to medical device sales. But in the case for Johnson & Johnson, it's actually going to be all about reviving their product pipeline while actually sunsetting those legal battles that they keep facing, and that's exactly what is happening. A very promising TAR-200 drug to defeat bladder cancer hitting the market soon. Either way, Johnson & Johnson has always and will always remain a long-term play for me, so let's click in here to see the last decade to see over 81% worth of reliable, steady appreciation, which is exactly what analysts just continue to forecast, in a bounce-back play with 17% worth of upside to come, which would mean a share price hitting $171.56. However, most notably with J&J is the amount of hedge fund activity that has been occurring. We see over 1.4 million shares purchased by smart money last quarter, and personally, J&J is one of my largest positions, and how could it not be, with a dividend yield coming in at 3.4% that has remained incredibly reliable over the last 108 years, growing by an average there of 8% year over year. But now say that J&J is not necessarily a growth-oriented pick for your portfolio, and that's what you're looking for. I urge you to take a look at the almighty United Health, ticker symbol UNH, which is one of America's largest healthcare providers. And thanks to a cyber attack not too long ago, and quite an interesting year here being election year, we have United Health on a discount, trading for $489 per share, which may seem expensive till you realize that this stock soared by over 596% over the last decade and shows zero signs of actually slowing down anytime soon. A matter of fact, recently, Optum Health revenue increased by 16.2% year over year and has been way above estimates. Not to mention our healthcare system in the United States probably not going to be changing anytime soon, so just expect United Health to blow right past analyst expectations of $565.92. That would be 15% worth of upside from where we stand today. Of course, smart money has been way ahead of us purchasing United Health shares, almost 1 million shares purchased already last quarter, buying back shares of their own as well here. United Health is coming in strong with that share buyback program. Now, here's why as a dividend growth investor, I love United Health. We have a dividend dividend yield coming in at 1.71%, but a growth rate setting the tone for all the other dividend stocks out there at an average growth rate of 41% year over year, while United Health has grown its dividend without interruption for the last 31 years. But now, as for the one opportunity that I'm personally most bullish on, and in my opinion, no pun intended here, is just on track to crush it when interest rates are cut, we have Norfolk Southern, ticker symbol NSC, operating in 22 states 24/7 to ensure your freight doesn't have to wait, gets anything from raw materials to finished goods where they need to go on time. However, we do have to recognize that costs have just been rising in this economic environment, and shareholders look at the near term, the bottom line, which can be foolish because it means that sometimes we actually forget about the long term and the big picture. Either way, right now, Norfolk Southern is trading for $216 per share. That means it slid by roughly 7.4% on the year. As you can see, when we were actually expecting interest rate cuts, it did trade for over $260 per share. But zoom out with me, we're going to see over 161% worth of share price appreciation over the last decade. Now, I'm not the only bull on Norfolk. Analysts project over 26% worth of upside, hitting $273.46 per share, but that is not all. Norfolk insiders at the director level have been buying hand over fist this past June, with almost $500,000 purchases, all while hedge funds have been pouring millions of dollars into the stock. So take note of that all. But the best part of being a Norfolk shareholder is, of course, the dividend to enjoy at a 2.5% yield, which has already experienced over 22 years worth of consistent growth while growing by an average of 16% year over year. So another great dividend growth opportunity. And now there you have them, investors, all 6 dividend stocks laid out for you. I want to know which ones you have in your portfolio, which ones you plan on buying or staying away from, or if you just have better dividend stocks in mind. Let me know all of your thoughts down in the comments below. If you're not subscribed to the channel already, you know exactly what to do in tapping on that subscribe button. I'll make this one easy for you as well. Tap right here for the next video and more insights.